In Chapter 8, we continue adjusting journal entries. On the liability side of the books, we review unearned revenue, and on the asset side of the books, accrued assets. Unearned revenue arises when a company receives cash in advance from a customer for products or services to be provided at a later date. It is often referred to as deferred revenue. It is a liability account. It is a liability because the company has an obligation to provide a product or service to a customer. For example, assume that a magazine company receives $60 from a customer for a one-year subscription. Cash is going up, but who has claim to that cash? Is it ours as an owner? Not yet. We have an obligation to provide that magazine to the customer. Until we provide the magazine, we have not yet earned the cash we've received. As the product or service is delivered to the customer, the company can record the revenue as being earned and reduce its liability. Consider, for example, Newsworthy magazine. Let's assume it receives $60 for a one-year subscription. Each month, January, February, March, April, May, June, July, August, September, October, November, and finally December, the company is obligated to send the customer a magazine. At the date the cash is received, we have a liability. As each magazine is delivered, we reduce the liability by $5 and earn $5 revenue. The journal entry we will record: debit the unearned revenue liability and credit sales revenue. Ultimately, the liability will be reduced to zero and we will have recorded $60 of sales revenue. The adjusting journal entry for unearned revenue always includes a debit to liability and a credit to revenue. Let's consider another example. In the case of Woods Golfing Academy, it receives $1,200 in advance from a customer on April 1st. As time passes and services are provided, the liability decreases. At the date of cash receipt, we established a $1,200 liability, which represented the 12 lessons. As lessons are provided, we reduce our liability account. If 3 lessons have been provided, at the end of the month, we desire a $900 ending balance, which represents the 9 lessons that remain. We need to debit the liability account and the credit recognize revenue on the income statement. So in summary, when cash is received in advance of providing the product or service, we credit the liability account. As services are provided, we reduce the liability account and recognize the revenue. At the end of the period, the liability balance represents the product or services outstanding and yet to be delivered to the customer. On the asset side of the balance sheet, we accrue assets. Companies deliver goods or provide services but do not receive payment. This is consistent with accrual basis method of accounting, which says that we should recognize revenues when earned, even if the cash has not yet been received. Common examples include accruing interest on loans we have made and rent. Let's assume Cameron rents office space to several companies. It is January 31st and one of its tenants has not yet paid its rent for January. We have earned revenue. The cash won't be paid until February. But if on January 31st we close our books, we must record an adjustment to recognize the earned revenue and the future collection of cash that we expect. We will debit a receivable account and we will credit a revenue account. On February 5th, when the tenant finally pays the rent owed for January, we will record the cash and we will reduce the receivable. We will not recognize any revenue because that was recognized in January at the time that the service was provided. The adjusting journal entry for accrued assets will always include debit to an asset, a receivable, and credit to a revenue. For a good summary of the adjusting journal entries covered in both chapters 7 and 8, refer to chapter 9 of Solid Footing.